Hi, my name is Spencer Leu, and today I'm going to talk about what is a mortgage loan. A mortgage loan is basically a loan securitized by your home. So what that means is if you don't make payments on your loan, the bank or whoever issued that loan to you gets your house. There are two main types of mortgage loans here in the U.S. There's fixed and then what's called an ARM or adjustable rate mortgage. In terms of the fixed, they're usually 15 or 30 years. And basically the interest rate and the payment are fixed over the life of the loan, whether it be 15 or 30 years. The current interest rates on these loans, for the 30, it's around 4%. And again, this will vary by mortgage provider. And for the 15, it's around 3.2%. Adjustable rate mortgages are fixed for a specific term, and there are also different variations, but this is the most basic variation. So you have a 5, 7, and 10 ARM. So for example, a 5-1 ARM is fixed for 5 years and then adjusts annually. And the interest rates on a 5-1 ARM right now are about 3%. Again, that will vary depending on your provider. Two quick tips. Don't buy points. So sometimes you can buy points which would lower your interest rate even further. In terms of my calculations, those don't come out in your favor, but if you can do the calculations and find that's not the case, then go ahead, but my recommendation would be not to buy the points, and make sure there's no prepayment penalty on your loan. And that's important because if you're to pay off your loan before the end of the time period, sometimes there's penalties, and of course you don't want to incur that should you need to sell your home. So to put these rates into context, I thought it might be interesting to take a look at interest rates over the last 50 plus years, and actually where the current rates are now, this is 2011, the interest rate, like I said, is now around 4%. We would have to go back 50 plus years to find rates this low. So you might be wondering if it's a good time to refinance if your rate is above the 4%. The answer is probably yes. Could it go down further? Yeah, it could, but you're looking at a 50-year low, and chances are it will have to go up at some point, but who knows when. And that's a lot better than here when we saw 18+% in terms of the rates. So is it a good time to refinance? Absolutely. Well, you might be wondering, what do you do if you're underwater on your loan? And that just means your loan is worth more than your house. There is a program, and it's called Home Affordable Refinance Program, or HARP. So here are a couple of the key points with this HARP program. You can use a different lender. A lot of people don't know that. You don't have to stick with your same lender, so you can get a couple different quotes and compare them. You must be current on your mortgage, so you couldn't have missed any payments within the last 12 months. Must be guaranteed by Fannie Mae or Freddie Mac. You can just go to their websites or ask the lender, and they'll be able to look that up for you. Must be your primary residence. You can't take any cash out. The PMI, that's the mortgage insurance, does stay the same, so if you didn't have any before, you won't have any now, and if you did have mortgage insurance before, it'll just stay the same. This program does expire on June 30th of next year, and it does let you borrow up to 125% of the value of your home. So let's say, for example, your home is worth $200,000. And you multiply that by 1.25, and that's $250,000. As long as your loan is less than $250,000, you would be able to qualify for this. So definitely something to look into if you're underwater on your home and you meet all this criteria. So just to give you an idea of the potential savings of doing a refinance, let's just say you have a $200,000 loan and the interest rate is 6% and it's a 30-year fixed loan. Your payment is about $1,193 per month. Now, if you're able to refinance at the current rate of 4%, the payment would drop to about $951 per month. And you can see that that's a significant savings. So from $1,193 to $951, and again, this amount, the $951 might be a little bit more because there is a cost to do the refinance, but you can roll that into the new loan if you're within the limits. But that's a savings of $242 a month. So definitely something you should consider and at least look into and see if you can get a quote, because that can save you quite a bit of money per month just by lowering the interest rate on your loan. Well, thanks for watching. I hope you learned some more about mortgages, and please take a moment to read these important disclosures. I'm Spencer Leu, the Finance Guy.